When global markets move, they usually whisper before they scream. But what if this time, the whisper has already turned into a silent stampede, and almost no one is paying attention? Over the past few months, something unusual has been unfolding in the silver market. Vault inventories are tightening, industrial demand is surging, physical premiums are widening, and at the center of it all sits one dominant force: China. The question isn't whether silver is moving. The question is whether China has just triggered the early stages of a global bank run on one of the world's most underestimated monetary metals, and whether investors are prepared for what could happen next. To understand what's at stake, we need to step back and examine silver's unique role in the global financial system. Unlike gold, which is primarily held as a monetary reserve and store of value, silver straddles two worlds. It is both a monetary metal and a critical industrial input. It is essential in solar panels, electric vehicles, semiconductors, medical technology, defense systems, and advanced electronics. More than half of annual silver demand now comes from industry. That means silver doesn't just respond to financial panic, it also responds to economic transformation. Now consider what is happening in China. As the world's second-largest economy and the largest manufacturing powerhouse, China consumes enormous quantities of industrial metals. Over the past decade, Beijing has aggressively invested in renewable energy, electric vehicles, and advanced semiconductor manufacturing. Companies like BYD have expanded electric vehicle production at a pace that has shocked global competitors. Solar giants like LONGi Green Energy are producing panels at scale unmatched anywhere else in the world. And every one of those solar cells requires silver paste. Every EV requires silver in its circuitry. Every data center expansion increases demand for conductive materials. This industrial acceleration has collided with a tightening global silver supply. Unlike gold, which is often mined as a primary product, much of silver production comes as a byproduct of copper, lead, and zinc mining. When base metal production slows due to weak global growth or falling commodity prices, silver supply can stagnate even if silver demand rises. That structural imbalance creates a vulnerability, and China appears to understand it. In recent quarters, data from exchanges such as the Shanghai Futures Exchange has shown sharp fluctuations in silver inventories. At the same time, global inventories tracked by the London Bullion Market Association and the COMEX have trended lower compared to previous peaks. While not yet at crisis levels, the directional shift matters. Silver markets are relatively small compared to global equity or bond markets. It doesn't take a massive capital reallocation to create price dislocation. What makes the current situation more explosive is the interaction between industrial demand and financial positioning. For years, silver has traded in the shadow of gold. During periods of monetary tightening, rising interest rates tend to pressure precious metals. Investors shift toward yield-bearing assets, and speculative flows retreat. But if a supply squeeze begins to materialize at the same time industrial demand surges, the usual macro playbook can break down. China's central bank, the People's Bank of China, has been steadily diversifying reserves over the past several years. While official focus has been on gold accumulation, broader policy direction has emphasized reducing reliance on the US dollar. In a world of increasing geopolitical fragmentation, commodity stockpiling becomes strategic. Silver may not command headlines like gold, but its dual industrial and monetary role makes it uniquely attractive in an era of supply chain nationalism. Meanwhile, Western financial markets remain heavily paper-based. On exchanges like COMEX, the volume of silver contracts traded daily far exceeds the amount of physical silver available for delivery. This fractional structure functions smoothly as long as most participants settle in cash rather than demanding physical metal. But history shows that when confidence shifts, when enough holders demand delivery, the system can experience strain. A bank run is not always about insolvency, it is about perception. It begins when participants collectively realize that claims on an asset exceed the underlying reserves. In traditional banking, that means deposits versus cash reserves. In metals markets, it means futures contracts and ETFs versus physical inventory. If China, whether through state entities, industrial buyers, or sovereign funds, aggressively accumulates physical silver while global inventories remain tight, the pressure point becomes obvious. Consider the scale. The entire annual global silver supply is measured in the low billions of ounces. In dollar terms, that market is tiny compared to the trillions circulating in sovereign bond markets. A modest shift in capital allocation from institutional investors, pension funds, or sovereign wealth funds could overwhelm physical availability. And if that shift coincides with industrial buyers locking in supply, liquidity can evaporate quickly. Adding to the complexity is the transformation of global energy systems. Solar installations have expanded dramatically over the last 5 years. China alone accounts for a significant share of global solar manufacturing capacity. Each photovoltaic cell requires a small but critical amount of silver. Multiply that by millions of panels, and demand compounds rapidly. Analysts have warned that substitution efforts, reducing silver content per panel, can only go so far without sacrificing efficiency. Electric vehicles further intensify the squeeze. Modern EVs require more silver than traditional internal combustion vehicles due to advanced electronics and battery management systems. As governments around the world push for electrification targets, demand curves steepen. If China accelerates EV exports and domestic adoption simultaneously, it amplifies the global draw on silver inventories. At the same time, geopolitical tensions have increased uncertainty around supply chains. Sanctions regimes, export controls, and trade disputes reshape commodity flows. If Western nations impose restrictions on critical mineral exports or technology components, reciprocal actions could disrupt silver supply routes. Investors understand this dynamic. Markets price not only present demand but future risk. Historically, silver has experienced explosive rallies when supply tightness meets financial fear. In 1980, a dramatic squeeze sent prices soaring after concentrated buying pressure overwhelmed market liquidity. Decades later, during the aftermath of the global financial crisis, silver again surged as quantitative easing ignited inflation expectations. While conditions today differ, the common thread remains. When confidence in fiat systems wavers and physical demand intensifies, silver's volatility accelerates. What differentiates the current environment is China's structural influence. Unlike retail-driven speculation, state-backed accumulation can operate strategically and patiently. If Chinese industrial firms secure long-term contracts while quietly increasing spot purchases during price dips, the cumulative effect reduces available float. Western investors may not notice until premiums widen and delivery delays appear. Another underappreciated factor is the leverage embedded in derivative markets. Hedge funds and algorithmic traders often amplify price movements once technical levels break. A sustained move above long-term resistance can trigger momentum buying, short covering, and ETF inflows. The iShares Silver Trust, for example, has historically seen rapid inflows during breakout phases. When financial flows layer on top of physical tightness, price acceleration can become nonlinear. Inflation dynamics further complicate the narrative. While headline inflation has moderated in some economies, structural inflationary pressures persist due to deglobalization and energy transition costs. Silver tends to perform well in environments where real interest rates fall or where monetary authorities pivot toward easing. If central banks begin cutting rates amid slowing growth, the opportunity cost of holding precious metals declines. China's domestic investors also play a role. In periods of property market stress or equity volatility, Chinese households often turn to tangible assets. Gold demand has already surged in recent years. If silver becomes perceived as undervalued relative to gold, measured by the gold-to-silver ratio, retail flows could intensify. Historically, when that ratio narrows from elevated levels, silver outperforms dramatically. We must also consider currency dynamics. A weakening US dollar typically supports commodity prices. If global diversification away from dollar reserves accelerates, precious metals benefit as neutral settlement assets. China has actively promoted trade settlement in yuan and alternative currencies. While silver is not a reserve asset in the traditional sense, it operates within the same ecosystem of monetary hedging. Critics argue that fears of a silver bank run are exaggerated. They point to recycling supply, substitution technology, and the ability of futures markets to absorb demand shocks. And it is true that commodity markets have mechanisms for adjustment, but those mechanisms take time. Recycling requires collection and processing. Substitution demands research and manufacturing redesign. In the short term, tightness can persist. The key question becomes timing. Markets can remain complacent until a catalyst forces repricing. That catalyst could be a sudden inventory drawdown report. It could be geopolitical escalation disrupting mining operations. It could be a sharp rally in gold spilling over into silver. Or it could be confirmation that Chinese entities have secured a disproportionate share of available physical supply. If such a catalyst emerges, the narrative could shift quickly from industrial growth story to scarcity event. And scarcity in financial markets commands a premium. Once participants perceive limited availability, hoarding behavior intensifies. Industrial users may stockpile beyond immediate needs. Investors may demand physical delivery instead of cash settlement. Premiums on coins and bars can decouple from futures prices. We are not yet at that stage, but warning signs deserve attention. Silver deficits, where annual demand exceeds mine supply, have appeared in recent years. While above-ground stocks buffer shortfalls, persistent deficits erode that cushion. The longer the imbalance continues, the thinner the margin for error becomes. China's strategic posture amplifies that risk. In a fragmented global order, resource security becomes national security. Stockpiling essential materials is not speculation, it is policy. And silver, embedded in renewable infrastructure and advanced electronics, fits that framework. For investors, the implications are complex. Silver's volatility cuts both ways. Rapid rallies can generate outsized gains, but sharp corrections can erase momentum just as quickly. Position sizing, risk management, and time horizon matter. Long-term holders often focus on physical bullion ownership. Traders may prefer liquid ETFs or futures contracts. Mining equities add another layer of leverage, responding not only to metal prices but to operational execution and geopolitical exposure. What cannot be ignored is the asymmetric potential. In a market as small as silver, structural demand growth combined with strategic accumulation creates the conditions for outsized moves. If China has indeed accelerated purchases, directly or indirectly, the tipping point may arrive with little warning, and here lies the deeper issue. Global financial systems rely on confidence. Whether in banks, currencies, or commodity exchanges, stability depends on trust that claims can be honored. A perceived shortage challenges that trust. Even rumors can spark reflexive buying. In tightly supplied markets, reflexivity magnifies impact. So the question returns. Has China just triggered the early stages of a global bank run on silver? The answer may not be visible in headline prices yet. It may be unfolding quietly in warehouse reports, industrial contracts, and shipping manifests. But history teaches us that when monetary metals intersect with geopolitical strategy and structural demand growth, the outcome rarely remains quiet for long. And if the crowd eventually realizes that the float is thinner than assumed, that physical availability is more constrained than paper markets suggest, the adjustment could be swift and unforgiving for those caught unprepared. As pressure builds beneath the surface, the most important development isn't the daily fluctuation in price, it's the structure of the market itself. Silver trades in two interconnected worlds: the physical market, where real bars change hands and supply chains matter, and the paper market, where contracts represent claims on future delivery. Most investors focus on price charts. Professionals focus on inventory flows. Over the last several years, global silver balances have quietly shifted into deficit. Industry groups such as the Silver Institute have documented periods where annual demand exceeded newly mined supply. While above-ground stocks can temporarily fill the gap, persistent deficits gradually tighten availability. The difference between a comfortable market and a stressed market often comes down to months of inventory coverage. Now layer China's demand trajectory onto that equation. Beijing's industrial policy under initiatives like Made in China 2025 prioritizes advanced manufacturing, clean energy technology, and semiconductor independence. These sectors are not marginal users of silver, they are core drivers of consumption. Solar expansion alone has transformed silver's demand profile over the past decade. Each incremental gigawatt of solar capacity installed translates into millions of ounces consumed. In parallel, global investment demand is becoming more sensitive to geopolitical risk. The freezing of sovereign assets during international conflicts reshaped how nations view reserve management. The message was clear: assets held within another nation's financial infrastructure carry political risk. For countries seeking insulation from sanctions or financial coercion, tangible commodities stored domestically become strategically appealing. This is where the narrative of a bank run becomes relevant. In a traditional banking system, depositors assume liquidity until they collectively test it. In precious metals markets, most participants assume that contracts can be rolled over or settled in cash without issue. But if industrial users or sovereign entities increasingly insist on physical settlement, the ratio of paper claims to deliverable supply becomes critical. Consider the mechanics of the futures market. On the COMEX, open interest often represents multiples of the metal actually registered for delivery. This structure is normal and efficient under stable conditions. However, during stress events, that leverage can amplify volatility. If a significant number of contract holders choose delivery rather than cash settlement, warehouse stocks can decline rapidly. China's domestic exchanges add another layer. The Shanghai Gold Exchange and the Shanghai Futures Exchange facilitate significant physical turnover within China's borders. When inventory shifts occur there, global traders sometimes underestimate the impact because the metal does not necessarily flow back into Western vault systems. In effect, silver that moves east can become less liquid from a Western market perspective. We have seen this pattern before with gold. Over the past decade, large quantities of gold migrated from Western vaults to Asian buyers, particularly in China and India. Silver could follow a similar path but with greater price sensitivity due to its smaller market size. Mining dynamics further complicate the outlook. The world's largest silver-producing nations include Mexico, Peru, and China itself. Production growth is constrained by environmental regulations, permitting delays, declining ore grades, and capital discipline among mining companies. Unlike the 2000s commodity supercycle, when miners aggressively expanded capacity, today's producers face investor pressure to prioritize returns over growth. That means supply elasticity is limited. Moreover, because silver is often mined as a byproduct of copper and zinc operations, its production depends on broader base metal demand. If global economic growth slows and base metal prices weaken, companies may reduce output, indirectly tightening silver supply even if silver prices rise. Another important variable is recycling. Silver recycling contributes meaningfully to annual supply, particularly from industrial scrap and old jewelry. However, recycling flows are price-sensitive and lagging. They do not respond instantly to rising demand. In a sudden squeeze, recycling cannot bridge the gap overnight. Meanwhile, financial flows are beginning to reawaken. During periods of rising interest rates, precious metals struggled as capital rotated into bonds and cash equivalents. But as central banks approach potential easing cycles, the opportunity cost of holding non-yielding assets declines. If inflation proves sticky while growth slows, a stagflationary environment, silver's dual role as industrial metal and inflation hedge becomes attractive. The gold-to-silver ratio remains historically elevated compared to long-term averages. When that ratio compresses, it often signals silver outperformance. Institutional investors tracking relative value metrics may begin reallocating accordingly. Even a small percentage shift in portfolio exposure can move prices substantially due to silver's comparatively low market capitalization. China's currency strategy also matters. The internationalization of the yuan has accelerated through bilateral trade agreements and settlement mechanisms outside the dollar system. While the yuan is not yet a dominant reserve currency, diversification trends support hard asset accumulation. Silver, like gold, offers insulation from fiat currency volatility. There is also a psychological dimension. Markets are driven not only by data, but by narrative. Once a storyline gains traction, such as strategic stockpiling by China, it can catalyze self-reinforcing behavior. Traders front-run expected shortages. Retail investors pile into bullion dealers. Premiums widen. Headlines amplify momentum. During previous silver surges, retail demand for coins and small bars overwhelmed mint capacity. Premiums over spot prices spiked, sometimes diverging sharply from futures markets. If industrial demand simultaneously strains wholesale supply, those premiums can persist longer than expected. Yet skeptics argue that fears of depletion overlook one critical point. Above-ground silver stocks are larger than annual mine supply. Unlike oil, silver does not disappear after consumption. Much of it remains recoverable. But recoverability does not equal availability. Much of the above-ground silver exists in industrial products, jewelry, or dispersed holdings not readily mobilized at current prices. Furthermore, silver's unique industrial properties limit substitution. It has the highest electrical conductivity of any metal. Alternatives exist, but often at the cost of efficiency or durability. In cutting-edge technologies, especially in high-performance electronics and photovoltaic systems, performance trade-offs matter. If China believes that securing silver supply ensures competitive advantage in solar exports and EV manufacturing, it has incentive to lock in long-term contracts. Even incremental increases in state-directed procurement can tighten global markets because of the thin margin between supply and demand. Let's also consider macro risk. Global debt levels are historically high. If financial stress emerges, whether from property markets, sovereign bond volatility, or banking sector fragility, capital often seeks refuge in tangible assets. Silver, historically more volatile than gold, can move sharply when safe haven flows intensify. At the same time, speculative positioning in futures markets can create squeeze conditions. If hedge funds build short positions expecting price stability and unexpected demand shocks drive prices higher, forced short covering accelerates gains. This reflexive loop has characterized prior commodity spikes. Energy transition policies add another structural layer. Governments across Europe, North America, and Asia continue subsidizing renewable deployment. Even if growth moderates, long-term targets remain ambitious. Solar manufacturing capacity is expanding, and silver remains integral to that supply chain. We should also acknowledge that China itself is a silver producer. Domestic mining contributes meaningfully to supply. However, domestic consumption frequently exceeds domestic production, requiring imports. If import volumes rise while Western inventories fall, trade flows become a key signal of tightening. The broader context is deglobalization. The pandemic exposed vulnerabilities in just-in-time supply chains. Strategic reserves of critical materials are no longer theoretical policy discussions. They are implemented realities. Countries are mapping dependencies and hedging exposure. If multiple nations begin stockpiling simultaneously, not just China, the cumulative impact could be substantial. What begins as prudent risk management can evolve into competitive hoarding. Market participants often underestimate how quickly perception can shift. Silver can trade quietly for months, then move double digits in weeks. Volatility itself attracts capital. Momentum strategies respond to breakouts. Retail participation increases during rapid price appreciation. The defining feature of a bank run is acceleration. It starts slowly, almost invisibly. Then a tipping point triggers a cascade. In silver's case, that tipping point could be a widely reported inventory drawdown, a surprise surge in import data, or confirmation that large state-backed buyers have secured supply. Until that moment, complacency can persist. Analysts debate fundamentals. Traders focus on technical ranges. Industrial buyers hedge incrementally. But beneath the surface, if physical metal continues migrating into long-term storage, especially within China's borders, the effective float shrinks. And when effective float shrinks in a leveraged market, price elasticity increases. Small changes in demand create outsized price responses. That is the structural vulnerability few are modeling aggressively. What makes this scenario particularly compelling is asymmetry. Downside risk exists as always, particularly if global growth slows sharply and industrial demand contracts. But upside risk under a tightening narrative is nonlinear. Silver does not require trillions of dollars to move dramatically. It requires a shift in expectations. If investors collectively reassess silver from a secondary precious metal to a strategic industrial asset under geopolitical competition, capital flows could reprice the entire sector. Mining equities would respond with leverage. Physical premiums could widen. Derivative volatility would spike. China may not need to announce any policy shift. Strategic procurement rarely arrives with press releases. It shows up in trade statistics, warehouse levels, and price resilience during corrections. And so the question intensifies. Is the world witnessing the early phase of structural accumulation that precedes a supply shock? Or is this simply cyclical fluctuation amplified by headlines? Whether this becomes a historic squeeze or a contained rally will depend on flows we cannot yet fully see. But one reality is clear. Silver's role in the global economy is expanding, not shrinking. And when structural demand growth intersects with strategic accumulation in a small leverage market, the potential for nonlinear outcomes becomes impossible to ignore. The world may still be whispering about silver, but if the underlying shifts continue, it will not be whispering for long.